Good evening everyone. So we'll do a revision of chapter 5 unit 2, income from house property, which is the second head of our income. So section 22 to 27 deals with income from house property. Section 22 being the charging section will tell any income or any revenue which the owner of an house property is generating from a building or land which is appurtenant to that building is chargeable to tax under this head. What is important here is that the rental income might not be straight away taxed, but annual value will be the criteria. Sir, what is annual value? Is nothing but gross annual value. We calculate this gross annual value by taking the help of standard rent, municipal value, fair rent and actual rent. Agree? So for our calculation of income from house property, the starting point will be gross annual value and not rental income. Clear? So that is what is given in section 22. Then there are two exceptions where the annual value of the properties are not taxable under that income from house property, but it is taxable somewhere else. What are those? If any house property which is owned by me, if I am using it for my own business or profession, then it is not taxable under income from house property. It will be taxable under that profits and gains of business or profession. Agree? Next, if I am in the business of renting the house properties, then it will be taxable under the again business income. Clear? Then notes, income from house property deals with self-occupied let out properties for residential or commercial use. So properties can be let out for commercial purpose or residential purpose, but for both are covered under income from house property only. Next, notional income provisions are applicable under this head, that is assessee is taxed even when there is no income. Why? See, the house properties are divided into three types. First one is self-occupied property or unoccupied property, which the assessee has occupied for himself and his family members. Maximum assessee can have only 2 house properties as self-occupied property. So for self-occupied property, normally gross annual value will be nil. Only interest on housing loan can be claimed. I repeat, only interest on housing loan can be claimed. That too, there is some maximum cap limit for it. So how much is that? 30,000. In some cases, if conditions are satisfied, it will be 2 lakh. When it is 2 lakh, we will see later. Then coming to the second criteria of property, it is let out property. Let out property means when the property is let out by a owner for a rent, any part of the year, even if it is let out for 1 month, it will be considered as fully let out throughout the year. Agree? In this case, we will start calculating income from house property from gross annual value. Clear? Then comes to deemed to be let out property. Deemed to be let out property means if assessee and his family members are using more than 2 properties for their own purpose, then in that case 2 properties only can be considered as self-occupied property, whereas all other properties will be considered as deemed to be let out property. Deemed to be let out property will be treated at par with my let out property, similar to my let out property. Clear? Whereas for deemed to be let out property, we take expected rent as our gross annual value, because actual rent will not come for deemed to be let out property. Be clear. So the last step will not be there. For calculation of gross annual value, there are 3 steps. Agree? So what is the 3 steps, guys? First, we will compare municipal value with our fair rent. Whichever is higher, we will take. Whatever figure we have got, we will compare with standard rent. It is given here. Whichever is lower will be my expected rent. Then I will compare my expected rent with my actual rent, that is annual rent minus unrealized rent. If there is unrealized rent, then if all the 4 conditions under rule 4 are satisfied, we can reduce it from our annual rent. If not, we cannot reduce it. Agree? Then we will get whichever is higher as gross annual value. This is when there is no vacancy. Sir, when there is vacancy, what is the case? Till expected rent, that is till step 2, everything remains same. Compare expected rent with your actual rent plus loss due to vacancy. Now the question is, sir, what is actual rent? Actual rent here means annual rent, that is the rent receivable throughout the year, minus if there is any unrealized rent, minus loss due to vacancy. So compare these 2 figure. If expected rent is less than or equal to actual rent plus loss due to vacancy, then your actual rent will be the gross annual value. If it is other way around, then your expected rent will be your gross annual value. Clear? Sir, what is the difference between unrealized rent and loss due to vacancy? Means Unrealized rent means the tenant is staying in my property, but he has failed to pay the rent. Agree? Only if all the four conditions under rule 4 are satisfied, we can reduce it. Then coming to loss due to vacancy. Loss due to vacancy means some tenant were staying in my property, now they have vacated. I am not able to find a new tenant for 1 or 2 months or 3 months. For that period, we will suffer some loss, which is called loss due to vacancy. Clear? Next, the format to calculate income from house property is given here. This is same for let out property and deemed to be let out property. Clear, guys? This is same for let out property and deemed to be let out property. So here we have already seen how to calculate gross annual value. We have already seen how to calculate gross annual value. Fine. From that, we have to reduce local taxes. Local taxes is otherwise called property taxes or municipal tax. If it is given in the amount, directly reduce it. Sometimes it might be given in percentage. That percentage should be applied on municipal value. Clear? It should be paid by whom? Owner. During when? Previous year. These two things are important. If it is paid by the owner, in the previous year only, deduction can be claimed. Okay, sir. Then I will get net annual value. From net annual value, I can claim 2 deductions under section 24. 30% of NAV is a standard deduction. Everyone can claim for let out property and deemed to be let out property. Then interest on loan payable. It is claimed on accrual basis, guys. It is claimed on accrual basis. Even though interest is not paid, still I can claim deduction. Agree? And it is there is no limit for let out property and deemed to be let out property while you are calculating interest. Whereas if it is a self-occupied property, there will be only one element, which is interest part. All other element will be nil. So you can straight away come for self-occupied property. You can come to 24B and check if there is any loan taken on house property. Whatever interest you are paying on that, you can claim deduction. But maximum is 30,000 or 2 lakh. Sir, when 30, when 2 lakh, we will see it later. Agree? So from house property, you may get an MCQ question. From a self-occupied property, what is the maximum loss you can get? 2 lakh or 30,000 depending upon the situation. So standard deduction we have already seen. So standard deduction is available only for let out property and deemed to be let out property, and it is not available for self-occupied property. Clear? And you cannot, sometimes in the question they will give some insurance charges, painting, repairs, this and all. Don't give any extra deduction for it. Agree? Then interest on borrowed capital, it is claimed on accrual basis. Then loan can be taken for 5 purposes. What are those 5 purposes? Acquisition, construction, then repairs, renovation, reconstruction. Agree? Loan can be taken for any purpose. Then, sir, whatever interest is related to pre-construction period, it starts from the date of loan and it ends on 31st March, immediately preceding the date of completion. So for this period, whatever interest is there, we can claim in 5 equal installment from the year in which construction is completed. Then coming to post-construction period, whatever interest is related to that year, you can claim in that respective year. So once the construction is completed, for the first 5 years, you will have 2 elements of interest. That is current year interest plus 1/5 of pre-construction interest. Agree? Both put together for a self-occupied property, maximum it can be either 2 lakh or 30,000, guys. Maximum it can be 2 lakh or 30,000. Hope you guys are clear. Next, self-occupied property, I have told you, maximum we can have only 2 self-occupied properties, guys. For assessee and his family members all put together. Interest on housing loan only will come for self-occupied property, maximum. If I have not taken any loan, then that also will not come. Okay. So maximum loan you can claim is, interest you can claim is 30,000. Okay, normally. But if certain conditions are satisfied, then it can be 2 lakh. Sir, what are those conditions? Loan should be taken, when it is 2 lakh I am telling, loan should be taken for the purpose of acquisition or construction. Acquisition means purchase, guys. Then it should be taken on or after 1st April 1999. Then construction or acquisition, for whatever purpose I have taken the loan, should be completed within 5 years from the end of financial year in which I have taken the loan. Clear? Then the 2 lakh or 30,000 limit is there, that is per assessee, guys. It is per assessee. Sir, I am a person who is having 2 self-occupied property. How much maximum deduction I can claim for interest? 2 lakh or 30,000 maximum. Clear? Then deemed to be let out property is similar to my let out property. It is similar to all calculation, everything. Only one change is, while taking gross annual value, there won't be any actual rent. So you have to straight away take expected rent only as your gross annual value. All other things, all other deductions are available as if it is a let out property. And I told you maximum 2 properties you can claim as self-occupied property. That benefit is available only for individual and HUF, guys. Only for individual and HUF. Clear? So all other computations will remain same. Then 25, section 25, inadmissible deduction. If any interest is paid outside India without deducting TDS, then you cannot claim deduction under section 24B for any property, for all 3 category of property. Then arrears of rent or unrealized rent which is related to some previous years received in this year. If it is received in this year, it is straight away taxed as income from house property even though you are not the owner in this year. But flat 30% deduction will be given. For example, if you have received 1 lakh unrealized rent, then minus 30%. So 70,000 only will be taxable for you as income from house property. Clear? Then coming to section 26, which talks about co-ownership. Co-ownership means I and someone else is a joint owner of the same property. So it depends now whether the property is a self-occupied property or let out property. If the property is a self-occupied property, straight away we can claim only interest. Interest 2 lakh or 30,000 is there now, it is not per property. Assume I and my wife is owning a property 50-50% share. Both of us can claim maximum for self-occupied property 2 lakh, even for the same single property. Even though the property is single, we both can claim 2 lakh as we are 2 different persons. Agree? Chalo. Next, coming to let out property. If the co-owned property or joint owned property is let out for a rent, in that case, calculate the income from house property as if the property is owned by one person. At the end, whatever income from house property you will get, divide it among the joint owners or co-owners. Clear? Next, there are section 27 will tell, in few cases, even though the person is not the legal owner, we will treat him as a deemed owner and he will be paying tax on it. He will be paying tax under the head income from house property. Why? Because section 22 told the basic criteria for an income to be taxed under the income from house property is, what is that? It is assessee should be the owner of the property. But here they are telling, even though you are not the legal owner in the following cases, still we will treat you as an owner for tax purpose. What are those cases? Transfer. If I have transferred my property to a spouse or my minor child other than minor married daughter. So my minor married daughter is not covered here. So if I have transferred any property to my wife or minor children for free or for inadequate consideration, then whatever they are earning from that property is taxed in my hands. Clear? Then holder of impartable estate, for example HUF. Then member of cooperative society. So if any property has been allotted by cooperative society to the member, then member is deemed to be the owner even though he is not the legal owner. Then if I am in the possession of the property as per Transfer of Property Act, then I will be considered as the owner even though the property is not registered in my name. Clear? Then last point, person having right in a property for a period not less than 12 years. So if I have taken any property for a lease of at least 12 years or more, then in that case I will be considered as deemed owner. Then coming to the new scheme, if the individual or HUF, if they have opted for a new scheme, then 4 things are not available for them under the new scheme under the head income from house property. What are those? For self-occupied property, you cannot claim 30,000, 2 lakh interest. You cannot claim anything. So if you are opting for a new scheme, your income from self-occupied property will be 0. Fine. Then if you have any brought forward house property loss, you cannot set it off against your house property income in this year if it is related to self-occupied property. Same way, if you have any brought forward depreciation, unabsorbed depreciation we will call it as, you cannot set it off against your current year house property income if it is related to some disallowed deductions. Clear? Last point is set off of current year house property loss. Okay, this year you have house property loss, you cannot set it off against any other rates. See, these 4 limits are not applicable if you are opting for an old scheme. Only if you are applying or opting for a new scheme, these restrictions are given. Clear? Chalo guys, we are done.